Thank you everyone for joining another episode of the ETF Securities Partner Series. Today we're joined by Anastasia Anagnostakos, who is a Business Development Manager in the Investment Products Division at the ASX. Now in her role, she's responsible for sales, distribution, product optimization and education of all ASX investment products, so including ETFs. And we're going to be talking about an update in terms of how the ETF market has gone in April, what investors and the trends that we're seeing, and potentially has there been any impact from the volatility on the wider investment product space. So Anastasia, thank you so much for joining us.
Kanish, thanks for having me. It's a pleasure to be with you here today, even if it's virtually.
Exactly right. I think people are much more comfortable at the moment with how things have gone, being able to do everything from home.
That's okay. I'm used to my living room as well. It's fine.
Look, we had your colleague Martin Din last month on the Partner Series. We talked to him about how the ETF market withstood the March madness. Yeah. Now in April, we saw the rally in markets. Has investor behavior changed in ETFs, or has it returned to normal? Could you give us a quick summary of what you've seen in the ETF market?
Define to me normal these days, Kanish. I don't know. What I can say is that the month of April posted its largest monthly gain for the S&P ASX 200 in its entire history. That was 8.78% up for the month. For the entire investment product suite, so that's ETFs, LICs, LITs, and fund, the gain was even greater, with total assets under management increasing by 10.8%. In particular, the ETF product suite was up 7.2% on the month. So that's a huge positive gain when you compare it to the month of March, which was down 10.5%. I think it's safe to say we're still far away from normal trading behaviour. Last month, we saw a flight to safety through precious metal ETFs or broad-based market ETFs, whereas this month, investors, rightly or wrongly, are reading into signs of a recovery, with both Australian equity and property ETFs being the main beneficiaries, both being up by almost 12% on the month.
Recently, there's been a number of articles about increased activity within the ASX market, especially driven by new investors, potentially retail. Has this been the case in the ETF market as well? And are there any particular areas where you've seen greater volumes or trends?
So, Kanish, without granular visibility to the type of investor we're seeing come to market, new or existing, given what we know about the ETF trading environment, coupled with anecdotal evidence, we can say much of this is new trading, be it through a direct online broker like CommSec or NabTrade, or through a full-service broker. I'm sure that you're in a similar boat to me. You're fielding questions from friends who have had little to no experience in investing and are seeing the potential opportunities the market is presenting. It's often in these times you have to remind them that you're not a financial planner, and any information you give is general in nature, hence why it's great to do informational webinars like these so you can point them in the right starting direction. There has been a recent report from ASX, however, that has highlighted retail trading behaviour in this time. And what it highlights is the sheer volume conducted by retail clients from the end of February into the start of April. To give you an overview, average retail trading volumes on the S&P ASX 200 pre-crisis was around 1.6 billion, and now it's around 3.3 billion a day, which is double their usual trading volume. As a percentage, accounts that were considered either dormant or new accounted for almost 22% in daily trading activity. In terms of the ETF market, a usual day pre-crisis accounted for about 4% of total trades on the ASX 200, but during this time it has ballooned to about 10% of total ASX 200 trades. Many investors have learned from our most recent crisis, so the GFC, such times often present a good price point to buy into the market and have been doing so with long-term and short-term ideas in mind. As a result, retail investors are using the opportunities in the broader cash equities market, where we have seen spikes in the WAX stocks, but we've seen a large pickup in ETF trading, which is usually institutional in nature. With many different options and retail investors these days, both via capital markets and through the listed product market, the choice can be daunting. One of the many beauties about ETF trading is that you can buy the entire index in just one $500 transaction. Whilst ETFs are being generally touted as long-term plays, the growing number and various strategies of ETFs, we're seeing them both used for long-term investment purposes and short-term trading opportunities, such as commodity and geared funds. And if you want further information about retail trading during this period, you'll be able to find ASX report on retail investor trading during COVID-19 volatility on their website.
Look, I think you mentioned, trading, people are, essentially trading their conviction with a number of ETFs. I guess that's something that it allows them to do. One in particular was, oil. And we saw oil prices becoming further depressed, even at a point where the futures market went negative for the first time. Now, that oil ETF, it's synthetic. Can you talk about why an ETF would be synthetic and the differences between a physical and a synthetic ETF? Obviously, ETF Securities, we've got the physical gold ETF, GLD, for example.
Mm-hmm. Sure. Kanish, as we know, there are two types of ETFs, physical replication and synthetic. So physical replication, for those that don't know, involves holding the asset being tracked to deliver the investment return. And it can be seen in products such as the gold ETF, which you've just mentioned, which is physically backed by the gold bullion, or equity ETFs, which hold physical shares. It's in some cases, such as oil, it is impractical and costly to physically store the assets. And as a result, investors around the world use oil futures to gain exposure to the oil market. The oil ETF gains exposure to the oil price by investing its assets into cash and then using a swap agreement that aims to closely track the price of an oil futures index. Although this results in the oil ETF being classified as a synthetic ETF, investors should be aware that the product is backed by cash, which is also used as collateral. Investors really should be clear, regardless of what product they're investing into, about the methodology of that particular product prior to investing in it. So download the PDS and read it before you invest in a product. In this case, like the spot price is often quoted in the financial press, but it's not possible to invest in that spot price because the purchaser can't take delivery of and hold the physical commodity. So investors should know that tracking the performance of an index based on commodities futures is different from holding the spot price of the commodity. The spot price refers to the immediate payment and delivery of a particular commodity. So the key difference investors need to keep in mind that with the physical, you are directly investing in the asset itself, so the spot price. With a synthetic ETF that deploys the use of futures contracts, the performance of the fund is linked with the value of the futures contracts of the oil and not the spot price or the current price. So as we've seen recently, that can be materially different. So when you've got large divergence between the spot price and the futures contracts, investors should expect to see considerable deviation away from the index that the ETF tracks.
The GFC and the COVID-19 crash, or March Madness, or whatever we want to call it, they're two very different events. So I'm not trying to compare them, but what I wanted to know is, for Australian investors, are we better positioned now to deal with any volatility, to deal with the crisis, than we were 10 years ago in terms of the investment offerings that are available to us?
Yeah, look, Kanish, I think you just have to look at the sheer size and the growth of the ASX product suite just to see how many different options are now available to investors. Let's look at the market, or the suite at the height of the GFC, June 2008. There were only 198 products for investors to choose from after buying individually listed companies on the ASX. As at the end of April 2020, investors have over 614 products to choose from, on top of all the individually listed companies on the ASX. So you could most definitely say that investors are spoiled for choice these days. Not only have the number of ETFs and the issues in this space skyrocketed, you also have at your fingertips the ASX M-Fund service, which was introduced in 2013, where you can trade over 225 managed funds the way you would a normal equity with a participating M-Fund broker, and there are 19 brokers in total. We've all heard that argument between passive and active management of funds over the previous decade. However, it is in volatile times where active managers do believe that they have the expertise and the mandate to outperform due to the extent of dispersion around the mean of returns compared to the pure beta players out there. So with so many options in this space in the way of LITs, M-Funds and active ETFs, investors are again spoiled for choice in this space in the way they learned in GFC. And there are different arguments for investing in an ETF as opposed to equity rights issues, where there are quite a few going around at this time. So let's say if you're holding some rights, or you've got the right to buy some discounted stock, there are a plethora of reasons why you would do so. You might want to lower your cost base. You might believe in the long-term growth of the stock. But as we know, Australians aren't well diversified as they are. We have a large skew towards Australian equities. So further investing in a single stock exposes you to further risk, or single stock risk, and can overall heighten the risk of your portfolio. If you want to diversify and lower your overall risk of the portfolio, ETFs are a classic way to do this, as they're pure better play. If you believe in the long-term direction of certain asset classes, strategies, sectors or geographies, and they represent good value to you in this crisis, then investors can seize the opportunity to invest in and potentially lower their overall portfolio volatility while still achieving good long-term returns.
Yeah, but I think that's right. It's the idea of pure diversification. ETFs obviously add that value alongside other types of investments. Now, we are seeing a slowdown in the launches of certain investment products, such as LICs and LITs. Have you seen that occurring in the ETF market?
So, given the closed-end nature of LICs and LITs, where there's a lot of volatility in asset prices at this time, postponement of bringing a LIC or a LIT to market is completely understandable from both an issuer and an investor perspective, and we've witnessed that occur. With the open-ended nature of managed funds and ETFs, it makes it easier under current market conditions to bring these products to market. That being said, as mentioned above, April only saw one admission to the ASX investment product suite, and that was an M fund. It's probably too early to say if there's been a significant slowdown in ETFs coming to market, as we're still seeing product emerge from the ETF pipeline. But this period is different to other periods of volatility, because people are working from home, which is another reason that we may have not seen any new products in April. Makes it hard to bring products when you're all working from home. And it might be safe to say that issuers in this space, we're wanting to see some stability before bringing some new products to the market.
Look, I think that's the case. It is something that we'll probably see more happening maybe down the line, or sort of second half of this year. Your role, and I mentioned at the start in the introduction, at the ASX primarily deals with the financial advisor market and educating them on the ASX listed options that are available. In your conversations, how are they coping, do you feel, with the market volatility? How are they interacting with clients?
Well, look, advisors are usually a pretty busy bunch, but I've made the old joke in this period that advisors and real estate agents are working harder than ever during this time to keep their clients informed and satisfied. Australians as a group of investors have been beneficiaries of a very strong stock market over the last 20 years, and many have factored in the fully franked dividends from our large cap stocks into their income streams. With the big banks either deferring or cutting their dividends altogether in their most recent announcements, one of the common discussions advisors are having with their clients is about mobilising capital within their portfolio to sustain their income streams, especially if they rely on the dividends for income, rather than trying to preserve the capital and live off the income stream as provided by dividends. This is often a really hard concept to have to sell to clients, given this goes against the status quo they've been used to for so many years. So in these times, the discussions we have with advisors are around the different income options that are available to them by the ASX investment product suite, through the vast amount of fixed income ETFs, fixed income and private credit LICs, LITs available with a steady income flow, lower on the risk return schedule than ordinary equities. The other selling point is that by incorporating such products into their clients' portfolios, they are diversifying away from that pure Australian equity play that many Aussies have been used to.
Look, I think, yeah, it's a case of making sure they're educated, communicating with clients, and this is obviously something that we're trying to do here as part of the Partner Series. So thank you, Anastasia, for participating. Hope to have you on soon. And for anyone else, please visit www.etfsecurities.com.au, and on there you can find the link for the Partner Series if you want to see previous episodes as well. Thanks so much, Anastasia.
Thanks, Kanish. Thanks, ETF Securities, for having me.